Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Evan Polaski. He is a Director of Investor Relations at Axia Partners, a diversified real estate fund operator focused on recession-resistant assets. He spends his days working with investors to better understand their investment goals and backgrounds. With over 16 years in real estate, he has seen all sides of real estate, from acquisitions to capital raising on equity and debt side to operations and actively investing himself. So, Evan, welcome to The Wealth Flow. Happy to have you on.
Thank you for having me. Glad to be here and looking forward to the conversation.
Yeah, me too. And I'd like to always just kind of start with your background, where you grew up and what eventually led you to real estate investing.
Yeah, of course. So I actually start with the real estate side because I remember growing up and having moved around a little bit as a kid that just always being fascinated by real estate for a period of time. And I'm talking, sub 10 years old, was living in Marietta, Georgia. So in Atlanta, a suburb of Atlanta, and in a traditional subdivision, but watching this new Publix anchored shopping center coming out of the ground and just being fascinated by it. Just, of course, at that age, 8, 9 years old, not understanding the financials and how it all works, just being like, that's so cool. I'd love to own that. Probably the kid collector syndrome that every kid seems to have at some point. But really just always fascinated by all types of real estate, whether it be office buildings, retail centers, and shopping malls to apartment complexes, and really, to some extent, into the design side. So that's kind of the real estate side. As noted, moved around. So have lived in, Chicago, Cincinnati, Atlanta, and then back to Cincinnati. Studied real estate through the University of Cincinnati Business College. So have a degree in business with a focus in finance and real estate. And as I've found, one of the few people who still work in my selected major.
Right.
Now, admittedly, I was an engineer that transferred into business, so I wasn't always in that major, but have kind of found real estate and just loved it. So started professionally as a W-2 employee in commercial real estate in 2007. Took a little stint off owning and operating a CrossFit gym of all things for about 6 years between 2013 and 2019, but still investing myself in real estate. And then once I sold that gym, kind of went back full time into real estate and have been here ever since. So that's been, 5 years full time with several years on the front end, without ever having what I consider truly leaving during that gym ownership period either.
Yeah. Okay. And so as far as the type of real estate, tell me a little bit on the W-2 with the commercial real estate. What type of work were you doing?
Yeah. So again, kind of, I guess it was a certain level of luck, fell into an investor relations type role. First job out of college. So I was the analyst on the in-house capital raising division for a grocery anchored shopping center business that is at the time was private, is now a publicly traded REIT. But I was brought in as the team was tasked to raise the second institutional fund for that company. And over that was kind of the main driver. And then we did some ancillary type raises. We did a triple net fund, what we call it was a development type fund, so sort of moving outside of the acquisition of grocery anchored shopping centers into more strategic investments, still retail, but outside that core kind of grocery anchored business. So a few private placements there. And that was the first several years of my career. And then, so that's really where it all started.
Yeah.
But since then have worked for, as I came back into real estate, was working for one of the largest multifamily syndicators out there with Axia Capital for 4 years. And just recently, not quite a year ago, 8 months ago, moved over to Axia Partners, who still focuses on multifamily, but also does some industrial. We own some self-storage, kind of have a bit of that opportunistic lean in different asset classes with a core focus more into that value-add multifamily as well.
Okay. Well, yeah, maybe if you could tell us a little bit about that, like obviously working for various operators, everybody does things a little bit differently. And Ashcroft obviously is a huge company. And so, yeah, tell us a little bit about kind of what you learned there that, maybe helped with the transition to your current role.
Yeah. So the biggest learning in particular was working in retail real estate, where you do have CMBS debt. You also have private bank lending debt, but back from 2007 until I, kind of bounced around the financial crisis due to just downsizings. But through 2013, when I bought and ultimately operated that gym, the cap rates were just totally different. 7 to 8 caps were good retail real estate. Mm-hmm. And then when I started at Ashcroft in early 2020, so even before COVID hit and prices got real crazy into 21 and 22, buying at 4.5 caps, which was, almost half of what I remembered. So obviously a big piece of that comes from how those financed, and particularly the Fannie and Freddie agency loans. Obviously, as we're seeing working through the market now, the floating rate loans, but those private bridge lenders competing to some extent with Fannie and Freddie's rates, that, you can buy at a tighter cap rate relative to retail because you're also borrowing at a much lower rate.
Yeah.
So that was kind of the big shell shock, initial learning, especially moving into that multifamily space. But then just, a lot of nuances in how institutions look at things versus retail investors or the typical accredited investor who's doing the $25,000, $50,000 type of investment. Kind of what the institutions allow, but even beyond that, just what they're looking for. Of course, there's value-add investors in every check size, but a lot of times, as I'm seeing myself today as an LP, core deals don't do it for me. I'd rather take on that higher risk of a value-add deal and let the institutions, the pension funds, the endowments who have kind of fixed intervals of cash flow needs that they're trying to cover, and they're just trying to diversify their portfolio and hopefully outpace inflation a tiny bit, just, if you're the pension plan, just to keep up with all your future liabilities that are coming through those pension needs. So getting to see a lot of that. And then from an operations side, it was interesting because one thing I loved about that first company is while they were a pretty large company, as I know, they continued to grow. They're publicly traded now. They were still private then, but they'd had about 300 shopping centers, 250, 300 shopping centers at the time, had been around. They were founded in 1992. So they'd been around for 25 years. Is my math right? uh, 15 years, I'm sorry, before I even got started, which is in the typical syndicator world, especially the multifamily mobile home park, kind of these asset classes that seem to cater to the W-2 employees that create passive income type messaging. A lot haven't been around more than 5 years.
Yeah.
So this was a company that had, corporate P&A, financial planning and analysis teams. They had their own acquisitions team with underwriters and then a separate due diligence, not separate, but a sub-arm of the acquisition team that were the due diligence managers who purely just ran the due diligence under the oversight of the lead acquisition officer. So kind of seeing that corporate structure, but also in their experience and they were huge on the education, kind of internal education side, which for me, just again, more luck than anything else, but got to sit and they put together internal trainings that anybody in the company could do to learn about Alta surveys and environmental reports. Obviously a bigger deal in retail than residential stuff, because you might have a former dry cleaner or a gas station on the corner that's closed down. The tanks may have leaked. So you got, there's just bigger environmental issues. But these details that you have to know to be truly educated in real estate, that I got to learn very early in my career through a company that really focused on, hey, we're happy to cross-train as many people as wanted. You could be an accountant and take that, internal course if you want. Take 2 hours, an hour and a half, 2 hours of your day to just kind of get a crash course in that type of material. So I think that was, being someone that just loves, having a bit of the engineering mindset of, I want to know how everything works. That was great for me. And then I've been able to use it throughout my career as I've, kind of continued to focus more and more into just the investor relations, capital raising type background. Because one thing I love about investor relations is, and I say this semi-jokingly, but you have to know everything about all of it without having to do any of it.
Yeah.
I kind of need to know how the acquisitions team is finding deals and where we are in deals and all that stuff without having to be the one who's calling brokers and and putting out LOIs and, trying to figure all that stuff out. Same with the operations side. I get to know how property management is, how many, what's happening in the asset management world without having to be the one to interview vendors and fire managers and hire managers and, deal with the tenants directly. So that's always a kind of fun way that I view my job. So yeah, that's kind of the early backgrounds, of it that I really enjoyed, that kind of carried me through to my current role. The other piece of it too, I'll note is as I mentioned, Axia does more than just multifamily, and, starting my career with a retail operator and seeing, kind of personally and capitalistically watching these two founders have, very large net worths, that, there's a bit of just, I want to learn everything from them, and they're doing it in retail. They're succeeding by far outside of any expectations that I've had for myself. But there was a little bit of that, like, oh, they can do it in retail. Like, this is kind of fun. And there's something a little, having worked in the retail space, a little egotistical, in that retail space and hotel space. Because it is very much a flashy, get people's attention, build the nicer shopping center, build the nicer hotel. And nicer doesn't necessarily mean more profitable, but to be profitable, it has to be catching the consumer's eyes, because it is very consumer focused.
Yeah.
Not to say that doesn't pass through into mobile home parks or multifamily or even industrial space. But that seems to be a little bit bigger type focus in those worlds that was kind of a fun, nuanced way, since a lot of people see retail as maybe a tough asset class. But it also made me, love real estate, but agnostic within real estate. There's opportunities in office, not that I know office inside and out. There's opportunities in retail, there's office opportunities in multifamily, et cetera. And really liking to play with those nuances, because they each have their own pros and cons.
Yeah. No, you got a great background just to be able to understand all that. And seems like just a really good foundation to be able to build on. So that's really neat. Well, tell us a little bit about Axis and what they're doing right now. As far as you mentioned, not just multifamily, but give us some examples of some of the types of investments that they're making.
Yeah. So again, we like recession resilient asset classes. So to us, when we are relatively new, we're growing sponsors. So we were founded in 2021 is when we closed our first fund. Within that fund, we have, or I'll kind of speak broader than that fund, but we have value add multifamily, we have self storage, we have a couple RV parks, we have again, not to be confused with mobile home parks, which some listeners might think they're the same.
Right.
I'm talking more the vacation destination type RV parks. Into industrial, we have a 230,000 square foot ground up industrial development going on. So the origin story was a bit of just, some founders with various real estate backgrounds. So our managing partners, one started as a house flipper back in 2010, buying houses in Utah off the courthouse steps, but grew and scaled that into having developed almost 7 million square feet of industrial space across his career, including like a 1.8 million square foot warehouse Walmart distribution center. One of our other founding partners came from the solar industry for his, kind of day job. But in doing that, started investing in real estate, doing multifamily, kind of scaling that up on his own from a fourplex into a 20, 1031s and continued to roll that. But he also syndicated and brought in the first, I believe still only Topgolf in Utah County, which is the county just south of Salt Lake City. Still kind of near that Lehigh, Provo type area. And so it was kind of moving in that development world of that specialty kind of retail, and whatever you would classify Topgolf as, kind of hospitality, kind of retail, et cetera. But he syndicated that deal before launching Axia and, ultimately brought them in as a ground lease and they built it up. So we have that diverse background, but where we are really focused, as noted, is we still have those connections, kind of those connections with lenders, understanding a lot of those, kind of back to 2010, buying property off the courthouse steps out of foreclosure, cleaning up title issues. So there's a bit of us that still focus a little bit on that. But the bread and butter going forward really is that primary focus into multifamily and value add multifamily. And particularly this coming, 6 to 18, 24 months, as a lot of, as I was kind of hinting at earlier, all the bridge debt that's coming due from 2020, 2021, 2022, the rate caps that aren't affordable anymore. We're starting to see a little bit of the cracking in the multifamily space on deals. And my personal, for as good as my guess is relative to anybody else's, is rates are going to stay high long. Yeah. We're going to be in this 5.5% to 6% rate for the next 12, 18, 24 months, since, currently stock market's still good, job market's still pretty strong. It feels expensive coming off of what we had 2 years ago. But in history, in the world, in the historic view, I was actually running some averages. I know I'm going on tangents here, that it's that we're only slightly higher than long-term average rates when you look at Fed funds rates across, what does the Fed report the last 60 years, 70 years?
Right.
I think they're averaging 4.6%. So we are higher, but not, I need these to go back to 2.5%, 1%, 0% type levels. So all that being said, debt's going to be more expensive for a long time. And I think those deals that are kind of hanging on by a thread right now, 6, 12 months from now, you're going to start seeing a lot more of those starting to go back to banks and having those opportunities arise in that multifamily space. Good quality assets, reasonably well run, just, they were structured incorrectly again, in hindsight, 3 years ago, 2 years ago. And that's going to become a big opportunity, I think, that we're going to see going forward. So for Axia's point, that's what we're looking to continue to capitalize on.
Yeah. And Evan, maybe describe that a little bit for the audience, the opportunity there. For folks that aren't maybe as familiar with the debt structure, talk a little bit about what some of these potential ones are, that the loans are going to mature and they're going to have to make a decision, do a refinance into something new, and kind of what opportunity does that pose?
Yeah. So really, we're on a correcting market cycle is how I view it. Like at the very 30,000 foot type view. You bought in the peak in 2021, early 2022. Obviously, rates went up. They went up faster and higher than almost everybody expected, just with how quickly the Fed did continue to raise rates to bring inflation under control. But these are, I don't like to use the term highly leveraged. Real estate in general, I'm not multifamily office, mobile home parks, relative to traditional businesses, your General Electrics of the world, your Apple, who has no debt at all, as far as I know. Your Tesla, I don't care what industry outside real estate, no other business or very few businesses that I don't know of any, or industries can run and sustain a 50, 60, 70, 80 plus % leverage type of business like real estate does. So I say that all because it's highly leveraged in a traditional sense. 60% LTV commercial deal is not high leverage relative to the real estate world, but outside of real estate, it is highly leveraged. So that being said, you have interest rates and you had an ever increasing values as we're coming into the run-up. There's just a lot more buy side demand, so a lot more buyers than there were sellers. So sellers can effectively name their price, as you're seeing in the single family home world too. Anybody that's been out there trying to buy a house seems to have cooled down a bit, but I'm in Cincinnati, Ohio, not even the hottest market in the country. And my wife and I sold a flip that we got $30,000 more than we were asking for, which equated to more than 10%, almost 15% more than we put it out there on the market. And I won't say we were aggressive with the price, but we were helping push the price on this flip that we did back in 2020, I'm sorry. So same thing was happening in the commercial space, particularly in multifamily. Much like the financial crisis, there's not one party to blame because, the Fed cut rates to zero. The private lenders, bridge lenders came in and started lending floating rate loans at very aggressive interest rates, SOFR plus 2%, 2.5%. So when SOFR was 0 or 0.25%, all in, you were only in, call it 2.75% was your effective interest rate. It could reset every single month, but people were, given COVID and everything that's happening, they were expecting 0% interest for a long time. So that just continued to put fuel on the fire. People would pay more. They would pay 2.5 caps. So 2.5% going in yield for those that don't know cap rates, and borrow at 2.75, knowing that they could push rents and bring that into balance pretty quickly. And it worked well as long as rates stayed low.
Yeah.
Hindsight, they didn't stay low. And in many cases, it seems not as long as people anticipated. In 2020, 2021, people were saying, oh, we've got 4 or 5 years of forward curves that are still basically at 0 to 1%. This deal makes a lot of sense. And it did until it didn't. So bridge debt, typically 3-year term, 2 1-year extensions is kind of your traditional bridge loan, private lender loan in the commercial space on a floating rate with interest rate caps. So almost everybody bought an interest rate cap because the lender made them buy an interest rate cap. So any syndicator says we're being conservative in buying an interest rate cap, that is probably true. They are. Why they are might be not totally their own doing as much as they like to make it sound that way. So they bought these interest rate caps, but those are 1 to 2 year, sometimes 3-year insurance policies. They expire too. So what happened? Several years later, the fast forward to 2024, you have these 3-year loans that are coming due. They might have an extension option, but to extend, they need to have certain coverage ratios. They need to have certain loan to value ratios. And on top of that, they also have these interest rate caps that may have cost them $50,000 in 2021 that now cost them $1.2 million to replace for the same insurance policy for the next year. So now they need to come up with $1.2 million on a loan to buy the cap to keep the coverage ratios correct.
Mm-hmm.
And if they can't, they have to buy down the loan, which costs a lot of money. And all told, there's not the money's not just sitting there in most cases. So that's where we are coming from. I'm hoping that was brief enough, detailed, but brief enough for people that really it's a lot of loan maturities. It's interest rate cap maturities. It's, things that we've been seeing for the last year that depending on how people were timed into the market might not hit. If they came in early 2022 before rates really went up, they might still have another 6 to 9 months before they're in any real trouble. So their investors might be looking at it saying, things are going great. I'm getting distributions, occupancy, rent's coming down a little bit. Maybe occupancy took a small hit, but overall we're still doing well. And those types of deals are the ones that, the writing's on the wall. If I am correct that rates are not going to move dramatically, I think I'm a little more pessimistic, but let's assume what the Fed is kind of indicating, 1 quarter rate or quarter point drop this year. That's not going to move the needle enough, even for those operators, 6, 12 months from now to save their deal.
Yeah.
In many cases, I won't say most cases, but in a lot of deals that I've seen, then it's kind of like it's just a time bomb waiting to go off that looks good now, but probably isn't in the next 6 months. So as I've phrased it before, the best operators, the ones with scale, the ones with good deals, good track records, and again, importantly, scale, they're probably going to be okay in the sense that they have access to capital. They can go and pull in pref equity if they need to. Maybe their investor base is more institutional biased. So a $2 million capital call is something most institutions can, kind of plan for, write the check for, and it's just fine. We bought the time, let's go. When you're into more of the retail side and it's hey, we need $5 million, which is ways to call it, 25% of the initial funding, somebody, a lot of retail investors, they stay fully invested. They don't just have $10,000 extra to put into a deal that they originally put $40,000 in. It's just not there. And when that call comes, it's debatable whether it's going to be successful and, whether that deal is going to be able to buy the time it might need to turn around. So we'll see. But again, those are those opportunities that Axia is anticipating seeing more of, as a lot of the market really is. That there's some indications that the market has bottomed out with the KKR acquisition of Quintera, which is valued at about I think it was reported low 5s to mid 5% cap rate. You had Blackstone taking AIR REIT private at, again, that kind of like low to mid 5 cap rate range. But those were also, from my understanding, very core, like best markets, best sub-markets, new construction type deals. And historically, if those deals are trading at a 5.5%, call those the A deals, then your B deals are trading at 6.5%, your C deals are trading at 7.5%, your D deals are trading at an 8.5%. So like, how far does it have to move to bring those C deals back to a 3.5, 4 cap? Is you need rates to be 0% again.
Yeah.
Maybe 50 basis point type rates.
Are you starting?
There's your market or your macroeconomic education, hopefully fairly understandable.
No, for sure.
7 minutes.
And are you starting to see some of, obviously the cap rates are expanding a little bit, but are you really starting to see that in the marketplace right now? Or are
You're
sellers
seeing a
still?
little bit of it. It's anybody that doesn't need to sell a deal isn't selling a deal.
Right.
Because they just know. There was a deal that I was helping a group underwrite in North Carolina that was, through and through a C to D deal. It was, kind of mid-size. I think it was 48 units, multifamily, rough side of the area. There's a shopping center right nearby that I think somebody was murdered on like 8 months ago. Again, those fluke things happen all the time, but again, it's just kind of a higher crime pocket. And this seller was approached by a broker who then brought it to the group that I was working with. And the seller's basically, I want a 5 cap for this. If you can sell it for a 5 cap, I'm selling it today. Underwrote it, and sure enough, it pencils out with today's financing to, an 8.5 cap, something like that. And, the group reached out to the broker who talked to the buyer who said they, just told him to pound dirt. So you have that kind of buyer who clearly is not in distress and doesn't need to sell.
Right.
Then you have some group that either see the writing in the wall. I think there are some groups out there that are like, we know what's coming, or we think we know what's coming. Our expectation is that this big, kind of hurricane of foreclosures is coming, and that might hurt prices even more. And we need to get out of our deals probably within that resolution timeline. So let's sell now. And yeah, we have to sell for less than we anticipated, depending on when they bought it. But it's better to sell now for a 6.5 cap. Let's, again, just throwing some random numbers out there, than potentially wait. And in a year when we really need to sell, the market's at a 7.5 cap. And we just lost, millions of dollars of value. So I think you have some of those buyers who are kind of on the more pessimistic view of how long this is going to endure and how bad it's going to be. And then you have the opportunists, the people who are like, I'm not one to say you should time the market, but I am one to say that the fundamentals should be there if you're buying in a questionable time. But I've seen deals out there, again, in the multifamily space where, there's groups that are still going in with negative leverage, or they're creating positive leverage. So they're buying down their interest rate on their loans on these deals to make it look like there's cash flow there, but in reality, they've prepaid their interest for the next 3 years. But you're seeing those deals that are coming out. So that's not every deal. There are deals out there that are trading at 7 caps and assumable loans at 4.75% in kind of tertiary markets that are, from a fundamental standpoint, market, take that side of the equation out of it. But, from a fundamental standpoint, it's like, yeah, if you can buy a 7 cap deal going in on 4.75% fixed interest for 8-year type loan assuming it's a decent asset in a decent neighborhood, like that's a great deal.
Yeah.
Buy it today. Could it be better in 6 months? Maybe, but it's still a great deal today that will endure you for the next 8 years. It's again, the floating rate loans, the interest rate buy downs, the buying in negative leverage where you're buying at a 5 cap, but you're borrowing at a 5.5 cap. Like that's just diluting investor returns.
Yeah.
And that's not the traditional fundamental that you saw in real estate for any real estate acquisitions, sort of, development or major, like kind of distressed type assets. Occasionally you'd see that type of financing, but the try and true value add is positive leverage and good fundamentals. And, that will endure you in good markets and bad.
Yeah, and let's maybe go back, Evan, to some of the ones that you had purchased in your first fund. Tell us a little bit more about maybe each one of those, the asset type and kind of what you liked about them.
Yeah. So in Axia's Fund One, as we call it, there's two multifamily assets. One is in Cookeville, Tennessee. The other's in Kansas City, Missouri. Both have been great. We're up 80. I should know this better. 60 to 70% NOI growth in the last 2.5 years on both of them. I think Cookeville is kind of a little bit north of 70, and the Kansas City deal is up about 60%. So just traditional value add deals. Some took some repositioning, like the Cookeville deal. For those that don't know, Cookeville is home of Tennessee Tech University, the largest public university in Tennessee, which is not actually the University of Tennessee. So it has a good employment and just kind of economic driver there for the city. And it's a reasonably small asset. I think it's 80-ish units. The prior owner was really just, I'll put it this way. We brought in our ownership, we obviously renovated the units, the traditional value add play, and brought down the average age of the tenant base, I think, by 20 to 30 years. So made it a little more youthful. Obviously, there's a lot of younger kids in a college town, but also just giving them the amenities that they needed, and we're able to drive revenue accordingly. In Kansas City, not the college town, but same kind of value add play, just finding these deals sort of in these, middle America type places with positive population growth, positive rent growth, kind of all the core fundamentals, but they're not the Orlandos, they're not the Atlantas, the Charlottes, the Dallas, the Houstons of the world, where you saw huge population growth. But with that, and what they're all suffering, not all, but a lot are suffering from, is that population growth and rent growth led to a charge of new development.
Yeah.
So Atlanta overall is seeing rent declines, as is Phoenix, because there's so much new supply that just came online or planned to come online that the existing deals can't keep rents up, nor can neither the new deal or cutting deals to get themselves filled up. So the new multifamily. So those are the two units. Again, kind of middle America type towns. We've got in that fund, we also have a self-storage deal in Calamus, Washington. That was a value add self-storage deal. So existing property with land to develop. And I believe it's already entitled when we bought it. But we are now under construction. Actually, recently poured the foundation for I believe about 200 new self-storage units. So in self-storage, the value add play, that's the more traditional version. Buy an existing property with some adjacent land that comes with it, and then you just develop more units to rent. So that one's in the works. The development side got slowed down a little bit, but it's moving forward. And looking forward to really driving the value there heavily. On the RV parks, we own two, one in Pennsylvania, one in Utah. We always looked for deals that have something unique about them in the RV park space. So it's a very segmented market, still is. But like our Saxton, Pennsylvania deal is right along the river. So we have boat access, and a big, not only are we one of the value add plays to develop more covered boat parking for any, either our RV tenants or just general market people who want to launch there. But we went in, and again, it was owned by the same family for 50 years, just a long time, who just really kept it as fresh as they could. So we came in, and, that's a bit of a hospitality play where it's a lot of management, it's a lot of, tenant relations. You get the seasonal rentals, you get the daily rentals, but paving in some new roads so that they can get to their sites a little bit smoother and not, the bumpy, gravel potholed type things. Increase the pool deck area. We're going to be adding a basketball court that wasn't there. We added a second, bathroom station with full plumbing year round. so that, people coming in the winter can still shower, because RVs, you obviously, if they don't have water supply buried, then you can't use the public water there. And again, just kind of cleaned it up and have gotten, phenomenal reception from the existing people. And I don't even know how much we've grown that revenue, honestly, but I believe we've more than doubled it in the 2 years that we've at that place.
Wow.
And then, similar to the Utah version, I'm losing my train of thought. I'm sorry. RV park. So those are the deals in that first fund. But as I noted, the RV parks, while they can be cash cows, they're so few and far. You kind of need to specialize in that because they don't come up for sale that frequently. So to be a fund operator or a syndicator, it becomes challenging because you might go a year and a half between deals.
Yeah.
And, if you're supporting a company or even just yourself doing that, that where I've talked to people who've had real success and scalable success in that space tends to be, I was talking with somebody at the Best Ever conference who owned 6 of them himself.
Huh.
He just bought cheap ones and did well, and he kind of bought a little bit more expensive ones as he had cash flow. But he did not sound like he had outside investors. And he's like, these are great. I run 6 RV parks. I make a really good living, kind of traditional, passive. He's active, but the real estate investor lifestyle. I kind of check in on a daily basis and I let him run. And, 6 hours a day, barring any major issues, I'm free to hang out with my family, plus, evening times, everything else. So, so that's where we see those. And then again, self-storage is a relatively saturated market. And I'm mentioning this stuff just because multifamily seems to be not only something that a lot of people understand from the LP side, mobile home parks as well, self-storage as well. But there's also a volume to it with the opportunity that we're seeing, that we anticipate seeing in a broader scale going forward the next several months. Which is why Axia is kind of narrowing that broader investment thesis down with a little stronger focus on the multifamily space going forward.
Okay. And on the, say, the RV parks, are you guys managing those? Do you have on-site management that you're overseeing? How does, because that obviously is a little bit more labor intensive from just a management role.
It is. And so we manage them ourselves. So we have on-site people that, basically we always found the, what's the phrase? It comes from the solar industry, the, something like lead from the middle. I'm probably misquoting it. And Dave and Jeremy, our managing partners, are going to punch me for misquoting it. But it's just really intended to be like the woman that runs our Saxton, Pennsylvania, actually is a husband-wife team who are both employees of that, and that's their full-time job. They were long-term seasonal residents that RV park before we bought it.
Okay.
So they came in, and that's a big piece of our success. Is she's been involved. She wants the best for it, as does her husband. Her husband happens to be very handy and can do a lot of the work as well, to kind of self-manage. But it's that's a big piece, is kind of, particularly in the RV world, it seems to be just, like you said, you can't do it from afar.
Yeah.
You can, you just won't be as successful as you could be if you bring in that person who, she's the paid manager. She has a house in town. So, 10, 15 minutes away in that bustling metro of Saxon, PA. And it's a very cute town, as I've been out there. But she keeps her trailer there. She is still a tenant of the RV park. And she's there, and she's got her neighbors that she knows really well. And she's out there having bonfires with them. And she's circling the community. So it's like everybody knows her. And it's just really increase that community vibe of the whole park. And again, because this is it's that weird, it's like people stay there a lot. It's a vacation destination for people.
It's not
But it's
people
also-
coming in and out daily. It's more of these people are repeat customers.
Yeah,
a lot of them, at least a portion of them.
Yeah. And we, in any RV park, you're going to have those daily sites because, I mean, for my revenue per site, you can make a lot more by just renting it for 1 or 2 nights. And people will want that. People are looking for places. Hey, I'm driving through, I'm doing the East Coast tour. I'm going to be in the middle of Pennsylvania. I need a place to park my RV for a couple nights. And then we're going to move on and go down to Wilmington, North Carolina. But so we definitely have those, but it is, most of it is seasonal. And that's much like multifamily. You want 12-month leases, office, you want those 5, 10, 15-year leases where you have long-term sustainable cash flow. We typically will sell about 95% of our seasonal leases before the end of the prior season. Like we know our cash flow a full year in advance, effectively, for that property. And so, and a lot of that comes from, her helping build that community, bringing in singers on Friday nights for the lot. The lot has a huge deck, and they'll do grill outs and have a singer out there, and people just, take their golf cart up or walk up from their RV and hang out, and they get to know their neighbor. And it's like, that makes them a bigger part of the community, which makes them more likely to renew, which makes them more likely to absorb when you're doing, modest rent increases over the time. They're not going to look at it and be like, I can't pay $25 more. They're like, I only have to pay $25 more to keep this whole network of friends that I've built now.
Yeah.
The same reason churches are so successful. And I came from the CrossFit world, the good CrossFit gyms that build that community, and it just creates a stickiness. So again, it's a slightly different industry, but it's same kind of metrics as you get with, I'm sure with mobile home parks, with multifamily. Anytime you gather people around, the more you can help them get to know each other and build friendships, the more likely they are to renew leases and stay long term.
Yeah, for sure. And refer friends, that kind of thing as well. So
exactly.
Cool. Yeah, that's neat. So have you guys already opened Fund 2, or where are you at this point?
We are, we're a 506B offering.
Okay.
I'll put it that way.
Okay.
So, you're always welcome to reach out to us. We do basically accept accredited investors only.
Mm-hmm.
Even though 506B does allow a certain level of sophisticated investors. But, if you're wanting to get added to our future distribution lists, find us axiapartners.com, message me on LinkedIn, which I know I sent you it's Evan Polaski. I'm one of, I think, the only Evan Polaskis in the world. Or even my email is evan@axiapartners.com. We'll set up a phone call, kind of just, typical process, get to know you a little bit better. And if it's the right fit, in the future, as long as we're staying compliant, we'll get you added to our list. But I will say the intent is that we will, have future offerings coming that would be available to investors.
Awesome. Well, no, this has been great. It's really neat to hear what you're doing. I love the idea of I know it sounds like you're gravitating a little bit more towards a focus on just, value add multifamily, but it's kind of neat to have on that first fund, just such diversity. And maybe can you talk just a little bit, give the audience just a little bit more of a sense on, when it comes to a fund structure like that, how their investment is kind of diversified across, all those various assets that you guys have under. So it's not just tied to a single one.
Yeah. And honestly, I was just thinking about this recently. But yeah, in a fund world, it kind of just adds a layer to a typical syndication.
Mm-hmm.
So in many ways, it can be the same as if you're listening to this and you've done a syndication in the past, or you've looked into them, very similar waterfalls, typically similar fee structures, sponsor by sponsor might vary dramatically. But typically the main skeleton looks similar. But in a fund structure, you're just adding that actual investment entity that then goes and buys the assets. And that way you have one investment that holds multiple assets. Where I've been thinking about this a lot again, and it's kind of been a a major part of this conversation is just the financing world of it. It gives a fund, not only gives you the diversification of assets, they're no longer tied to a single asset, a single location, a single tenant or tenant base. You have multiple and presumably a diversified pool of multiple types of asset, or at least multiple geographies if the same type of asset. But it does other things if executed properly. It can provide staggered debt maturities. You look at every publicly traded REIT, and one of the big metrics that analysts are looking at is their maturity calendar. I don't care if it's multifamily, retail, office, industrial, whatever. Like, if you have a lot of debt maturing in the next 2 years, next year, your stock price is going to take a big hit because there's a lot of risk to that. Mm-hmm. I distinctly remember a company when I was early in my career in the financial crisis. It was called Developers Diversified Realty. DDR was their stock symbol. They almost went under. Not because they had bad assets or they're overly heavy vacancy. Yes, as the financial crisis and retail world was getting shaken. They just had a lot of debt coming due, like in 2009 or 10. I forget what exactly it was, and literally the company's entire enterprise value went down to like $150 million. This was a multi-billion-dollar REIT. That debt maturity almost collapsed the entire company. They got rescue capital from a major investor, worked out, and ultimately, were able to rebound and do well. But you can't do that with a single asset. Single assets, you have one loan, one debt maturity. If it hits at a bad time, you're stuck. That's it. So things like creating those maturity ladders can be done in a fund. You can do different things from the financial side that can actually help boost returns, like creating, I'm in a fund. It's actually a retail fund as an LP that has a capital commitment facility. So they, I committed my money and they call it over time, and they use that capital commitment facility with my and everybody else's commitment as security for that loan, so that they can go and buy assets without having to call my capital right away. So it gives me kind of a more steady schedule of capital calls, still somewhat relative to acquisition, but I like it because even though my money's, I kind of have it available to answer that call when it comes, it means they can buy that asset and kind of get it up and running and through the first 3 to 6 months of operations before my money comes in. So when my money comes in, like, they're already up and running and off to the races, and creating, reasonably good returns based on their value plan or their business plan accordingly. You can't do that in a single asset syndication. And when I'm going to hit on the single asset, because everybody says I've raised many funds, or at least several funds, and most investors are like, but I don't know what assets are going into that. It's like, yeah, you don't. But you know how many syndicators, decks I see that I won't call them lying to you, but like, if you invest in that and they've identified the asset, like, you don't know what you're getting anyways. And this isn't a dig on people. That's why you're paying syndicators and giving them a share of the profit and fees to do what they do. But it's always interesting to me when people are like, but I want to be able to do the due diligence. I'm like, cool. Fly to, Tulsa, Oklahoma, walk that property with a property manager and the inspector, talk to lenders and understand what they're doing, hire your own property condition assessment. Like, if you want to do the due diligence that we do at Axia, then like, you're going to be spending $100,000 just to underwrite this deal before you ever invest. So,
right.
Kind of the, don't give me, you're going to do your due diligence. You're going to do some surface level checks, which I appreciate. And if that's what makes you comfortable, great, do it. But even as simple as like a CoStar report, like CoStar costs something like $50,000 a year. You don't have that.
Yeah.
In all reality. So, again, I'm an LP. I make my own mistakes as well. It's just like kind of the, don't delude yourself to think you're doing real due diligence in these deals. Because, as we're seeing now, if you took out floating rate debt in 2021, and I'm in deals that did that personally, like, you have no equity. I can almost guarantee anybody in one of those deals, regardless of what the syndicator's telling you, if they had to sell today, and maybe they don't, you have no equity. Or very pennies on the dollar. That's fine. If you've got 5 more years to ride this out, 6 more years, you're probably going to be fine. If you only have 12 more months to figure this out, might want to start writing that investment off in your head. Again, not every deal, but a lot of those deals with floating rate debt in 2021 are in that position.
Yeah. No, a great point. Yeah, thank you, Evan. I think that helps. That just helps to understand, some of the benefits and some of the differences between the two. This has been great. I know we're running a little bit long on time. Where can, if you could maybe tell everybody where they can find out more about you. I know you mentioned the LinkedIn, but just where they can find out more about you. If they want to get on your, newsletter, they want to, hear about what you have coming up.
Yeah. Email is simple. It's Evan, EVAN, AxiaPartners.com, AXIA Partners.com. LinkedIn is always an easy way. I try to check those messages reasonably regularly, but as everybody does, they get a ton of spam. So forgive me if I'm a couple days behind. Those are the best 2 ways to initially reach out, and then we'll move you into the other kind of more traditional channels accordingly, however that works out. So those would be the best 2 ways to reach me. Unfortunately, I don't have anything but a personal Instagram page, or I'm not trying to be a guru that's building a social media following.
Yeah.
Yet, at least.
There you go. All right. Well, I've got 2 other questions for you that I ask every guest. One would just be, any advice you might give somebody who's just starting out in their investment journey.
Kind of get out of your own way. It's whether you're looking at the active deals. My first real investment was buying a single family rental, and I owned one house. I was living in my first ever house that my wife and I bought together. And when it came to buy that first single family rental in 2010, when it was all of $22,000 to buy a 3-bedroom, 1-bath house in Cincinnati out of foreclosure, it was terrifying. I remember getting the call from the realtor saying, "You got it." Like they accepted your offer. And I'm like, what did I miss? Like, that was my initial thought. Why am I the highest bidder?
Right.
And you just kind of have to trust that a little bit of the excitement that you get when you're starting to ramp up and really get into it, and kind of trust your gut and just go with it. So on the active side, that's definitely, but even on the passive side, that first time, I know for a lot of investors, it's hard to write that first check. I always tell everybody, invest what you can afford to lose. Well, I don't think anything that Axia is doing is going to lose our investors money. In fact, they're all performing quite well. Some are fully stabilized. Some are still on that good trajectory too there. It's you got to kind of take that risk, even more so when you're not controlling it, I think. Because at least if you're controlling it, you can kind of understand it and you're seeing it day in and day out. Right. When it's passive, it's kind of if you've got, whatever it is, if you're $50,000 is your number or $25,000 is your number, then just stick to that. And when that deal ends up being a home run, don't sit there and get all bent out of shape because you should have put $250K into that first deal that made a 3x multiple in 3 years. You also could have lost all your money if you made that kind of investment. So it is just sort of that get out of your own way. And it's regardless of investing, anything you're doing new, as I think most people know, it's going to be a bumpy road. There's going to be frustrations. There's going to be things, but whether, again, it's tenant frustrations by owning your first single family rental, whether it's a syndication that was well regarded, but they're pausing distributions, just know that those are going to happen. And that's part of the journey. You got to kind of I try to take those with the positive note of just it might cost me money, but it taught me something. You know what else cost me money and taught me something? Going to the university.
Yeah.
And that had I maybe was going to make some money more than I would have if had I not gone. But it's kind of that same thing. Like, you're always just paying for an education if you view it that way.
Mm-hmm.
And I'm not saying you shouldn't try to make money, but take those losses, and that's another question or 2 or 10 that you should be asking the next syndicator when you're looking at another deal, whether it's the same actual syndicator or the next, different group. But understanding those, what taught you a lesson in the first place, make sure that doesn't get lost on you.
Yeah, I think that's great advice. How about a book recommendation? It doesn't have to be real estate related, but it certainly can be. Just something that's been impactful.
Yeah. Principles by Ray Dalio.
Okay, yeah.
You've probably heard it more than a few times. It's one of those multiple, if you're a business person, you read it. Hard not to follow the successful multi-billionaires and the books they read that are giving you insights into how they think about things. But I actually heard about it because I'm typically more of a casual reader, but this covers some of the founding principles, imagine that, of what brought Aaron, Jeremy, and Dave together to form Axia.
Okay.
So again, just it's been a great read. Obviously, a very successful investor with Bridgewater Associates and leading that group to multi, tens of billions of dollars of equity under management type side. But yeah, it's been a good read.
Yeah, no, thanks. Great recommendation on that as well. Thank you, Evan. This has been fantastic. Appreciate you joining us on the Wealth Flow today.
My pleasure. It's great being here, and sorry for keeping us a few minutes longer than anticipated.
No, it was well worth it, man. Well worth it. All right, thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.